A wealthy investor traded $327 million on Amazon stock options today, February 28. So in this video, we will analyze what this unusual trade means and show our option strategy based on this wealthy investor's trade. Because as we all know, the rich get richer, and so by following their trades, either bullish or bearish, we have a better chance to make money in the stock market. For example, in early February, Amazon reported earnings, and we made 400% profit because we accurately analyzed the trades of wealthy investors who were bullish. So we had a pretty good idea the stock would rally after earnings, which it did. For more details on this, here's the video we published about this, so you can learn more about how our strategy works. This is the title of the video. You can search it on our channel. We'll also put a link at the top here if you have info cards turned on. So without further ado, let's get into the trade from today. As we can see here, at 10:44, 43-second, 155,000 contracts. But we also notice that at the same time, this wealthy investor was also trading these two other trades here, which in fact is the same trade, since this is the same expiration, March 15, and the 145 strike calls. So this is the amount added together that they traded, along with this trade here, this 155,000, all done at the 43-second mark at 10:44. So we know this is the same wealthy investor. So what is this investor doing? Let's take a deeper look at the chain from March 15. We can see here at the 145 strike calls, open interest of 132,000 contracts. This is open interest, and we see that the volume is slightly lower. We believe they are taking profits and closing out of this trade. Okay, so they closed out to take profits on these 145 strike calls by selling them to close. And what they're doing for the Junes, you can see here, as we go down to the 160 strike price calls, we can see here volume of the 155,000, much greater than the open interest of 20,000. So we know that these are opening trades in which we believe they are buying these to open, essentially rolling out their calls to a higher strike price from the 145s to the 160s, and also rolling out in time from March to the Junes. So you can see here, by calculating the price that they paid for these, how much this trade costs. So 21 and 10, so that's 2,110. Since this is in options terms, we have to multiply by 100. So the $21 times 100 is 2,110 times the number of contracts, 155,000 contracts, and that is why this trade is $327 million. So quite a significant trade. But keep in mind that Amazon is a $1 trillion company. Okay, so because it's a $1 trillion company, $327 million is not as significant. However, it is still something very meaningful. So we will still trade it, but it is lower probability of profit in comparison to our trades that we share on our website, which we'll put a link at the top here if you are interested in gaining access to the trades that have higher probability of profit. Because even though this trade is 327 million, Amazon trades off so often. You can see the volume, daily volume. Lots of investors are trading it, and sometimes there could be a wealthy investor trading perhaps $400 million tomorrow or next week. That could be bearish. And so this complicates the data analysis on these trillion-dollar companies. Okay, so go to our website if you want the higher probability of profit trades, where we share our options strategies as well, such as this one here. So here is the option strategy that we are trading based on the fact that this wealthy investor is going bullish because they are buying those call options, right? So the call options for the Junes, as we mentioned, they were buying these 160s. Essentially, this is what it looks like, clearly going long. And as we mentioned, they're paying 21.10, so this is the price that they were paying. We also know that this is going long simply because we can see from the Greeks, the delta is a positive delta. It's a 71. If it was a bearish trade, it would be a negative delta. So our trade here, we went to the Julys, and you can see here what we did right here, our position here at the 180s. We bought the 180s and we sold the 190s. And we don't put a lot of capital in this because, as we mentioned, this trade is lower probability of profit in comparison to our trades that we share on our website. You can see that this trade here cost only $370 per trade, much less than the $2,110 from the wealthy investor, right? So this is a vertical call spread, and we can essentially determine how much we want to risk by position sizing by the number of trades we want to trade, because the amount of our position will help us determine our risk in this trade. Okay, so if for simplicity purposes, we'll use one contract to show how much we're risking, 370 here, and you can see the potential profit is 630, the blue line, showing max profit of 630. So this risk to reward ratio, because it's 630 of profit divided by 370, you can see that we can potentially make 170% on this trade. So we prefer to have trades that exceed 100%, so that if we're risking 100%, we could lose 100% on this trade, but we want to make sure that we can make more than 100%, so that the risk to reward is in our favor. And so that is how we trade, and that is why even if we have some losers, that our winners can make up for the losers, because it's not how much you make or lose, but how much you make when you win and how much you lose when you lose. So as long as we can make more than when we lose, we always come out net profitable, right? So so that is our trade. Let us know what you think will happen to Amazon. And as usual, please smash the like button. And if you're interested also in the trade that we place before Amazon reported earnings, where we were able to set up our trade based on finding out what the wealthy investors are trading bullish. I'll put a link to this video over here. And also our website has a lot more information too over here. All right, take care and have a wonderful